All right, it's happening, folks. The commercial real estate collapse is starting to kick off officially. Starwood Capital Group, led by Barry Sternlich, is facing default on a $212.5 million mortgage linked to an office tower that he has in Atlanta. And this situation is part of a wider trend right now that the commercial real estate industry is facing, where corporate landlords, including Blackstone and Brookfield Asset Management, have ceased making payments on office buildings that they consider unprofitable due to rising vacancies caused by increasing adoption of remote work. Additionally, borrowers have been hit with higher financing costs as the Federal Reserve raised interest rates in order to combat inflation, while property values have actually started declining. And according to data from financing firm Trepp, the delinquency rate for offices with commercial mortgage-backed securities surged to 4.5% in June, up from 1.7% just a year ago. So it's important to note, most commercial-backed security financing is non-recourse, which means owners can abandon their properties without exposing themselves to further financial consequences. Tower Place 100 is a 29-story building in Atlanta, and it's experienced a decrease in leasing, dropping from 87% in 2018 to just 62% by the end of 2022. The Atlanta area office vacancy rate has risen to 22.4% in the second quarter, surpassing the US average of 20.6%, indicating a broader struggle in the commercial real estate market in that region. So the question remains here: is this the beginning of the commercial real estate collapse in America? The commercial real estate market is currently facing concerning situations here that some experts fear could surpass the challenges witnessed during the 2008 financial crisis. Analysts at Morgan Stanley have started raising red flags, and they're pointing to recent loan defaults by prominent office landlords and a decline in demand for office spaces as warning signs. Adding to the growing apprehension is the fact that a significant number of commercial mortgages are actually due for refinancing in the coming years, and that's making this situation increasingly precarious. Rising vacancy rates are particularly troubling, with major markets like Manhattan and Silicon Valley experiencing record high vacancy rates in commercial real estate properties. And this indicates difficulty in finding new tenants as old leases begin expiring. This is leading to downward pressure on rental properties and prices as values start to come down. The looming refinance challenge adds to the complexity of the situation. Higher interest rates and increased vacancies might make it a challenge for property owners to secure favorable refinancing over the next couple of years, potentially leading to even more defaults and then, of course, financial instability in the market. Such a crisis could have broader implications, of course, for the overall economy, causing a slowdown in lending, reducing business investments, and a negative impact on the economy and its growth. Empty offices and commercial properties can also have a detrimental effect on the tax base of local municipalities, potentially leading to budgetary challenges and difficulties in funding essential services. However, there are some factors that suggest the crisis can be contained. Other segments of the commercial real estate market, like industrial and retail, as well as hotels, they're actually performing relatively well, providing a buffer against potential risks. Moreover, banks have maintained strict lending standards, and most debt in the market generates sufficient income to meet these standards, and indicating a certain level of stability here and preparedness in the industry. Furthermore, banks have reported excellent credit performance in commercial real estate lending, with low delinquency rates and minimal losses thus far, which suggests that lenders have been cautious enough in their underwriting practices and have managed risk effectively. So in conclusion today, while the commercial real estate market is facing challenges and there are signs of potential trouble ahead, a full-blown crash in 2023 is not guaranteed. The market's resilience, diversification of assets, and strong credit performance provide reasons to believe that the crisis can be contained and avoided entirely. However, it is essential for stakeholders, including banks, real estate firms, and policymakers, to closely monitor the situation, take necessary precautions, and consider innovative solutions to mitigate risks and ensure the long-term stability of the commercial real estate market. It's definitely going to be interesting to see where this all leads as the ramifications are very substantive. So we're gonna make sure that we keep you posted as new developments are made. Don't forget to like and subscribe to the channel so you don't miss any of our videos. Turn on those post notifications as well so you're alerted every time we upload one for you. Make sure you share this video with anybody that you think could use it, because keep in mind, as the fallout potentially continues, more opportunities will continue to come up. So it's best to be prepared and keep a close eye on everything that this market is showing us right now. Look forward to seeing you on the next video. Until then, make it a great day and keep on cash flowing.